Everyone loves to talk about how to make money in the market, but very few talk about how to keep it. The truth is, protecting your capital is far more important than chasing quick profits. Because if you lose 50% of your money, you don't need a 50% gain to recover. You need 100%. That's why smart investors focus on risk management first. Let me show you what that really means. Back in 2023, we saw how quickly things can fall apart when risk is ignored. Remember the collapse of Silicon Valley Bank? It wasn't because the bank was small or unknown. It was one of the biggest in the US, but they made one simple mistake. They invested heavily in long-term bonds without properly hedging against rising interest rates. When rates spiked, the value of those bonds dropped fast. Panic spread, deposits were withdrawn, and the entire bank went down in days. Billions were lost, not because of bad luck, but because of bad risk management. You don't need to run a bank to fall into the same trap. Many individual investors make the same mistake in smaller ways. They put all their money into one stock, one ETF, or one asset class, believing it's safe. But diversification is the simplest and most powerful form of risk management. It's like building a table with 4 legs instead of one. If one leg breaks, the table still stands. Yet diversification isn't just about owning many things. It's about owning different things. For example, owning 5 tech stocks isn't real diversification. When tech drops, they all drop together. True diversification means spreading across sectors, regions, and asset types, like stocks, bonds, cash, and even commodities. Another key part of risk management is position sizing, deciding how much of your total money goes into each investment. If you put 50% of your capital into a single idea and it fails, you're done. But if you limit it to 5% or 10%, one bad trade doesn't destroy your entire portfolio. Professional traders call this survival first. Your job isn't to win every trade, it's to stay in the game long enough to let the odds work for you. Now let's talk about emotional risk, the one that ruins more portfolios than any spreadsheet ever could. Think about crypto investors during the 2021 boom. Many ignored risk entirely. When Bitcoin hit $60,000, people went all in. They used leverage, borrowed money, and believed it could only go higher. When prices crashed, they didn't just lose profits, they lost everything because they had no plan for what to do if things went wrong. That's where a simple rule like a stop loss comes in. It's not a perfect tool, but it forces discipline. It's your emergency exit, a rule that says, if this drops 10% below my entry, I'm out. It's not about being scared, it's about being prepared. There's also something called liquidity risk, the danger of not being able to access your money when you need it. If all your money is locked up in long-term investments and an emergency happens, you might have to sell at the worst possible time. That's why having some cash on hand, even if it earns nothing, is part of smart risk management. Cash is not laziness, it's flexibility. And here's one more thing most people forget: the risk of doing nothing. Yes, playing it too safe can be risky too. If you keep all your money in cash during high inflation, you're losing purchasing power every day. So the goal isn't to eliminate risk, it's to balance it. Risk management isn't exciting, it doesn't make headlines, but it's the difference between staying in the game and getting wiped out. Because the best investors don't think, how much can I make? They think, how much can I lose and still be okay? Protect your capital first and the profits will take care of themselves. Thanks for watching, and I'll see you in the next video.